CMQ investors, welcome to the show. This is Chris Franco, and like you, I am currently contemplating what to do in what is now considered officially a bear market. I wish I had a bear sound effect. I would play that right now, but I'll get serious here because I don't want to make this a joke. I know that a lot of you are very nervous, very uncomfortable by what's going on right now, and that's totally normal, by the way. We are in very uncertain times, and while I think that the future is always uncertain, and I think by definition that's true, there are times when that reality is a lot more apparent, and that's what's going on right now. I also think the contrast of going from, I don't know what it was, a 2-year period maybe, where it felt like you had to pretty much, just do something egregiously dumb to lose money in the stock market. Now it feels like you can't do anything right. But what the bear market has done for me, and it's, again, I'm still, like, we just started, so I don't want to act like I'm Mr. Wisdom, but I do want to share what's helped me, because you guys, if you've been listening to the CMQ Investing podcast, you know my process. I've been trying to, internalize, well, first of all, find, but then internalize these enduring lessons about investing that really work. And, in recent months, I've talked about doing things like keeping a certain cash position, because I know that gives me a psychological cushion if and when the market does take some sort of turn. It keeps me from doing something stupid, which would be panic selling. Secondly, the fact that, I'm trying to shift my current allocation of my investment portfolio to be predominantly in low-cost index funds like the VU. That's something I've been talking about. I think I'm currently at like 62% VU. Not to say the VU's done well this year, but I'm a long-term investor. I'm a CMQ investor, so I know there's going to be years like this. Now, in terms of, the bigger picture here, what does it all mean? The good thing with the bear market is, well, we've had bear markets before, and we will have them again. This is not some sort of, uncertain. This is not, how do I say this better? Look, there's not a playbook for this, but we're just going through something that, any investor of a certain age has gone through. And something that I've always been like this, like you, I go through times in my life where things aren't clicking the way that they are at other times. And I don't know where I got this sort of thinking from, but I sometimes embrace that because I think to myself, I'm paying the dues now to get to the good stuff. Because at least in my experience, as my 34 years on this earth, I've not had, any experience where things are just awesome all the time. That's just not how things work. You have to grind at certain things. You have to take your adversity. You have to respond to it. You have to battle through things. And then you get to those moments and you really appreciate them because you had to battle through something to get to it. I think that's pretty normal. It reminds me of one of my favorite Charlie Munger quotes. I'm not going to say it perfectly, but it's, the best way to get what you want is to deserve what you want. And he's talked about that a few times, but if I think back to a University of Michigan lecture that I'm going to reference here in a moment, he mentions that, the world's not a crazy enough place to reward a bunch of undeserving people. And I don't think he means that in some sort of like metaphorical or in a literal way, as if, it's like a karmic thing. But the way that our world works is you have to put in the work to get something back out most of the time. There's always going to be those anomalies, right? Like somebody who's just undeserving, but that's not the statistical norm at all. I would say it's a statistical anomaly. Now, when I think about being deserving here, what am I talking about? Well, the reason that I'm a long-term investor is because I know that if I, put my money to work responsibly and I have a long time horizon, I have my psychology down, my temperament down, I manage my finances in a way where I'm not going to need to go into those. I'm not going to touch any retirement accounts, obviously, but if any brokerage accounts, I'm not going to, pull stuff out and have to, interrupt the compounding process that way. Well, I know that given enough time, it's nothing certain, nothing's 100%. But if the market does anywhere like it's done in the past 50 years moving forward, well, there's a very healthy outcome, right? Like it's a very nice outcome considering, and this is a Charlie Munger expression here, considering you just get to sit on your ass while your money makes money for you. And then thanks to the miracle of compound interest, the money that your money makes money. So of course there's going to be times like this. Of course it's not going to just be, every day you check your accounts and it's, hey, up again. Doesn't make it any easier, but I want to at least try to give us that perspective. I know that's what I've been thinking about. Now, what I want to caution all of us about, and this has just been I've been really on a Jack Bogle kick lately, and if you're not familiar with Jack Bogle, I've definitely done some episodes about him. But Jack Bogle was someone who really called out, I call it the investment business, in a way that really no one had the guts to do before, or at least no one had the incentive to do before. And he completely changed the realm, changed the landscape for individual investors like us. We are all benefiting from Jack Bogle today. He passed away in 2019, but I feel like in my own small way, I want to help his legacy carry on. If I've learned something from, and again, I could go down this path, but let me stay with where I'm going with this. What I want to caution us to is everywhere you look, there is some sort of expert telling us what we're supposed to be doing right now, whether it's, hey, now's the time to de-risk. Now's the time to take some profits. Oh, you might want to shift from growth to value. It's time to get into bonds. I could go down the list of things that wherever you turn, you're going to hear someone telling you what you should be doing. What I learned from Jack Bogle, and it checks out, and Warren Buffett and Charlie Munger have both echoed this, but typically, not all the time, but typically, when we have to make moves or take action, someone is profiting from that, meaning the industry is profiting from us, whether it's in the form of a transaction cost, a commission, some fund that has a higher expense ratio. I'm sure there's more ways that I'm not even fully aware of. But the point is, and I feel like this really does check out, the more we move, the more we tend to lose. And I'm speaking as an individual investor. I know we have some hedge fund folks that listen. Your scenarios are very different, or your situation is very different than those of us who are just individuals trying to make the best use of our savings. But regardless, I think that's something to keep in mind, because I've also gotten a lot of messages when I do Instagram lives, which I do pretty frequently. Say, hey, what do you think of this stock? Or, things are on sale now. Should I be buying? First of all, I've said today actually, and this is now I'm calling it tough love with Franco. If you're asking me my opinion on the stock, don't get me wrong. I'm happy to give you my thoughts on it. But if you're asking me for my opinion, you shouldn't buy it, because, well, if you guys want me to explain that, I'm happy to. I don't mean it to sound so harsh, but I think that's going to be my new go-to response. And that goes back to something that's important we remember, which is the importance of thinking for ourselves. So I get why people ask, and it's okay to ask. Don't feel like you can't ask me questions, but generally though, this is funny. I have not actually I've not logged into any of my accounts since all this stuff started. Not because I'm scared, not because, I can't deal with it. I can't deal with it. Oh my God. Can you, Connor, I should do a skit with Connor opening his accounts. You gotta be kidding, buddy. Christmas is canceled, kids. But what happens is you look at your accounts and then you start thinking of stuff to do. And I just know I don't need to do anything. I'm not suggesting that, I'm not going to have volatility to deal with, but I know what I own. And I heard Jack Bogle say something that he didn't say it this week, but I heard it this week, which is, if you can sit tight if you picked right, meaning if you put your money in the right things, meaning things that are reliably can deliver you returns over a long period of time, like the S&P 500 index or whatever you're into, well, then you can sit tight. But one thing that keeps us from sitting tight is looking. Don't peek, because it's not good. There's a tendency to start thinking, I've talked about this before too, and I feel like I'm able to hit a lot of subjects here. There's this tendency for us to think that money, those temporary unrealized gains are like, that's our worth now. And so you start to think of yourself as this person that's worth X amount more than you were, let's say a year ago or whatever the case is. And when you watch that start to evaporate, you start to, I should have sold, I should have taken some profits. It's all psychological. And what I encourage us all to do is follow the mantra that is CMQ, compound money quietly. That's what we're trying to do. That's the most reliable way to build wealth in the long term. And we know that the most, I'd say, effective, the best way to build wealth, long-term wealth, you have to tap into and leverage the power of compound interest. And you need to have a long time horizon, and you need to not screw it up. So if you're sensibly invested, if you have a long time horizon, you've got some cash that if worse comes to worse, you can, you can dip into it without interrupting your your investments. Just try to avoid falling for the traps that are going to be everywhere. At least that's my prediction. Everywhere you look, somebody's telling you what to do. Because, again, there's an entire profession that exists to make us feel like, we need their help. And the only help you need right now is the help of wisdom. Learn from the legends. That's what I'm trying to do, and I think that those lessons stand up. I'm going to provide like I'm going to provide a report. No, I'm going to record and publish another episode this week because I'll explain this in a second, but it's going to be a Jack Bogle centered conversation, and I found this speech that he gave many years ago talking about 12 principles for investing in bear markets, which is obviously perfectly timed. You can't time the market, but you can time the podcast, buddy. I also want to say that for those of you who are very much, only podcast listening, and I get not everybody's going to, be on YouTube. I apologize that we have not been delivering the same quantity of episodes that you've come to expect. That has been weighing on me. It's not been something that's happened because of any sort of lack of care or dedication. We have a lot of moving pieces right now at my company. When that includes CMQ, obviously CMQ is being integrated within, and we're going to find the right cadence. But as you know, I've been trying to figure out, or I don't know why I said trying to figure out. We are figuring out, future interviews and things to really help continue to evolve this podcast and just continue to create more value for you and other individual investors who are looking to, think as rationally as they can about what they're doing with their money. So I just wanted to give you that update. I don't want to bore you to death with all the nitty gritty, but I just wanted to acknowledge that we are definitely a little behind on output, at least on the podcast, if you compare to previous months. And that is something I hope and plan to resolve moving forward. If you have not been made aware, I've been very active on YouTube. And I'm very much experimenting right now. So you see, I shouldn't say you'll see a different side of me. You'll see me. But I have found that the humor that many of you enjoy in audio form, when I'm able to add the visual element, I can do some ridiculous stuff. And so I'd say, it's 90% rational. I'd say 95% rational with like 5% just absolutely ridiculous. Like no one's doing anything like this, for better or for worse. just destroying my professional reputation for the just to get a laugh. No, we're not doing that. But and it's been really fun. I've been really passionate about it, and I think that, and I could be wrong here, but it feels like there's without a doubt a shift towards content. I think content, and I don't want to speak about myself in the third person, but the kind of content that I have been creating, for investors like you, I believe there's a lot more investors that are now, I think we should invite them in because they've followed the wrong people, as I know I would have 10 years ago, if I was 24, if I had the accessibility that is now, provided to investors of all ages and been able to, just load up Robinhood on my phone and buy in and out of stocks, I would have made every mistake in the book. So I don't want to, I want to acknowledge I've heard from people that are starting to find the CMQ content because they've been seeking out something that really stands up no matter what the time is. And I want to close with this. I was going through notes. I'll tell you more about some of these entrepreneurial things later, but I was going through old notes and I found some notes I wrote to myself when I was first fleshing out the idea of doing this little passion project that was just initially Charlie Munger quotes. And then that quickly became the newsletter. And, I was just writing down, I want to create content that has, enduring value for those that consume it. Like I imagine, and this is here I go with an analogy, but something that has it gives you the gratification of like eating a sweet, but it provides the nutritional value of eating something really healthy for you. So we can make, I can throw the entertainment in, we can, make formats that are more digestible, but that we're loading in really useful wisdom that is not just stuff because people say it's useful, but I go out and I try to see if this stuff works for me. And if it does, I tell you about it. And I tell you if it doesn't work. I've been very candid with both successes and failures. That's following Charlie and Warren, again, rubbing my nose in my own mistakes. So before I talk you to death, I love how I'm, I love how I'm like it's a podcast. I'm like, sorry, I'm talking so much, guys. I'm sorry, I'm so talkative. I just missed you guys. I miss talking to you. But I appreciate you listening as always. I really do. If you haven't hit the follow button, whether you're on Apple or Spotify, just a friendly reminder to do that. As podcast discovery is not the best, it's still pretty archaic. So that's the best way you can ensure that you never miss an episode. Doesn't mean you have to listen to the episode, but we have a catalog now, and it's been fun hearing from people who've gone back, and I've heard from people that have binge listened, which kind of blows my mind because I can't tell you the amount of effort I've put into this. I'd do it again if I could. It's been very rewarding for me, but it feels really cool. It feels really cool. God, just stop being so. I sound like I need therapy. Can't talk about my feelings. No, I just appreciate it a lot. I really do. It makes it all the more rewarding, and I don't mean that to sound. It probably sounds a little corny, but it's genuine. If you know me, you know I'm being genuine. I goof around, but when I'm serious like this, I mean it. So thank you for supporting CMQ Investing. I appreciate you guys, and we will talk soon. Take care.